We've got Ayaz Motiwala as well joining in on the show. Ayaz, hi, morning. How is it that you're looking at the big Monday crash, not just for our markets, but for across the globe as well? Does it deter things on the kind of move that we've seen from March, and how your investment, analogy is going to be for 2021?
Yeah, morning. Hi. I would say it's fine in the sense that we've had almost a one-way move from the March lows, and so it's only fair, to expect some sort of correction which came in. It was a little sharper than probably what people would expect in an ideal scenario, but markets are not sort of ideal, and they always surprise. So this was a little bit of a sort of a winter pinch, if you will, with cold hands by the market, and sort of a forewarning that things are not just unidirectional in markets.
Connected.
Ayaz, what should be the return potential now for next 2-3 years, considering that markets are not cheap, valuations are stretched, and a lot of scenarios which talk about earnings recovery, margin expansion, they are in the price. Are we in for like flat returns for good stocks, looking at the entry points now?
Obviously, individual stock will have their own sort of merit. Excuse me, can you hear me on this? Hello?
Yes, we can hear you.
Yeah, sorry, I'm sorry. So, Nikunj, yeah, just to put that in perspective, I would say we've had pretty narrow market, and the reason being that the elusive economic recovery has continued to sort of stay away from a broad swath of companies, and the hope that we have, I would speak for ourselves, is that we are in the midst of some sort of recovery, and there are ample signs of that, and then probably you've been pushed by the sort of the COVID crisis for people to start looking at investing as well. In the form of especially capacity expansion across the hard assets, whether it's cement plants or steel, or even sort of malls and hotels, where people are indeed actually looking to put up money to work on looking out the next 3 to 5 years. So yes, indeed, the starting point valuations of some companies are where they are, but we think that the earnings will surprise, and that's our expectation. We'll see how it plays out, but our expectation is that the earnings will surprise, and that should be the basis of some sort of return expectation.
Oh, what has been your tone of activity? What have you acquired last, where you feel that markets are not pricing in earnings recovery and the surprise is coming?
Yeah, I'd say more of the what we would call quality cyclicals. I've talked about sort of auto and auto parts, and that's where we've been active on it, and we think that is where the room for surprise is much larger. So indeed, there has been a sharp recovery, from the COVID lows for some of these stocks, which are probably up 50 to 100%. But to put the market in perspective, we're probably up, barely sort of 8-10%, especially after the 4-5% correction on the other day for the year. So so people are obviously a little bit surprised and point themselves to the V-shaped recovery. But the fact of the matter is, this is the only level of returns that we have seen in aggregate, and then obviously individual securities as they are. So quality cyclicals is where we are sort of constructive on. On the other side, we've taken some money off the table in terms of sectors where we were bullish a prior probably 18-24 months, and we think it's become it's become meaningfully expensive, and probably things are looking expensive 2 years out as well, which is specialty chemicals. So we've taken quite a bit of money off that and put it into these kind of names, quality cyclicals as I call it. Whether it's related to the steel cycle, related to the construction cycle, or auto and auto parts. So this is what we are up to as things stand. Of course, the bellwether sort of stocks such as banking remain as part of this economy recovery play that we hope does play out.
Let me ask something which is your expertise, understanding consumer companies. Which are the top 3 consumer, not companies, but stocks which do you think have potential to give a double-digit CAGR return in next 2 to 3 years? Not companies. Companies we all know, Nestle, HUL, fantastic companies. But which are the 3 consumer plays or stocks you would like to buy?
Yeah, so we own the 3 names which are sort of Marico, Britannia, and ITC in our PMS portfolio, and which we run under QRC in India. And so those are we are very bullish on. We think for different reasons, each of these securities are hopefully going to surprise on earnings, whether it's new product initiatives in case of Marico, or sort of continued momentum of consumption in the case of Britannia, or the under appreciation of the consumer business that ITC has built out as sort of headline thoughts on it. So we think these are the 3 sort of large cap stocks we think which are very interesting. They are large in sort of size, but they should have the kind of returns that you talk about, mid-teens to even higher over the next 2 to 3 years. This is despite the current starting valuations very clearly that we are aware of.
Okay, fair enough. Ayaz, what's really surprised you, let's say, during these last few months, the recent leg of the up move as well? While we have started to see a little bit of rotation coming in, as you said, markets are not unidirectional, but what's really surprised you as a trend, something that's caught your eye?
Yeah, so I'd say first the most honest one would be that, I think the ferocity with which the recovery happened in the rest of the world, including India. So I don't think people were that confident, and I'd be probably dishonest if I say that we'd expected down 40% to fully recover by the end of the year, but we are. So that is, I think, the biggest surprise as market continues to sort of chug along. That being said, I think the sort of, I wouldn't use the word complacency, but sort of the treating it as a one-off, especially for the financial and banking sector, where we've seen a pain, once in a century, it sort of go through. And, there is obviously the moratorium period which will end. So I think that is an area where, which is also surprised on how people have treated that one-off a lot more, sort of in passing rather than taking it very seriously. So I guess maybe market participants are looking at, that 18-month period as a one-off and then move on. And I guess, each investor will have to reappraise that process in their own sort of capacity. So I think these are the 2 distinct ones where I'd say that, and there have been sort of small side shows as well where I think people wrote the demise of IT, and now IT can do no wrong. You all just mentioned about IT being strong today, and it was strong yesterday as well. And the way auto and discretionary consumption has come back as well. So these have been sort of smaller sort of pockets of surprise. And I think the hope trade on recovery still remains. So while we say there is evidence, and there is indeed evidence, I think for this broad-based economic recovery to show up will be the upcoming surprise. And we are surprised on how slow the growth has been, particularly for the last 2.5, maybe going up to 3 years post the ILFS episode. So I hope that we do come out and we actually start getting to the 6-7% real GDP growth.
Still hopeful there, Ayaz. Does that mean that perhaps you're disappointed also with the kind of lackluster move we've seen across the financials? Clearly, they're going to be in sync with the recovery, and we're not seeing as broad-based a recovery as one would have hoped naturally.
Probably thread your question along with what Nikunj also asked, which is, why are we here in terms of this valuation for that small corner of the market of 20-40 stocks? That has been primarily that, from 2012-14, this country has obviously attempted to come out of that period of downturn, whether it's, sort of taper tantrum or the lack of liquidity then and then starting from there. But it hasn't really happened. And so the recovery has been elusive. So the market participants, like ourselves included, have chased a narrowing base and a narrowed sort of base of companies which are, growing earnings of that of that economic sort of situation. So so that is indeed a sort of a negative surprise, and it's kind of repeating what I said, which is that we've been hopeful of this recovery for many years to come, and it has continued to be elusive. So while we continue to remain optimistic and hopeful, these kind of corrections of the recent one should be a call on essentially not sort of paying up too much for this recovery as well. So it's a little bit of a tricky balance that you need to strike, because if there's a sharp recovery in autos, there's a sharp recovery in construction activity and real estate, etc. Then the kind of numbers you could see in, say, paints, tile companies, etc., would be a massive surprise. Whereas if you look at the 3 years gone by or the 5 years gone by for, say, a small sliver of the construction side business such as tiles, the numbers have been flat. I mean, it speaks about the robustness of the business, where the company has been able to report very solid sales and maintain profitability, but there hasn't been any growth. So if you look at names like Ajaria or Serra, etc., they have had much sharper sort of price move, and even barring the COVID lows, you probably have from low to high moves as high as 60-70%, which means that people have bet on it and then they have sort of retreated. Not seeing that sort of recovery come by. And thus, obviously, P multiples as a function of flat earnings have sort of vacillated in that very wide range.
Ayaz, what one saw on Monday and what we're seeing today as well is buying in IT. Sure, it's coupled with a Wipro buyback and a couple of deal wins as well for TCS, etc. But, IT is a macro trade which was well discovered in March. We all knew that in the post-COVID world, you got to be invested in IT. But what we're seeing peculiarly is that it's more of the same that, people are gravitating towards. The same discovered stories like IT. Do you sense that the texture of the market in the months to come is going to be the same, where IT is going to continue in leadership, with, yes, other sectors participating, but a large chunk of the market staying put in IT, and pharma perhaps added to the pack?
Yeah, it's a well-established fact that there are these, 3 or 4 businesses in India, IT, pharma, FMCG, and financial services on a selective basis, which have been long-term sort of, value and wealth creators, and some have sort of cyclical element, and some are much more structural in nature, such as sort of consumption and maybe domestic pharma. So that goes, if you want to be in India, whether you're a small retail investor or a large foreign investor, you need to be in these businesses. And so you're right in the sense that it's a repeat of that. But what you're going to discover, there are going to be a few IPOs which have come by, and some of them have been brilliant, such as, say, the DMart IPO, which is a large-size consumer company which got listed. Or a couple of insurance companies or a couple of asset management companies. But barring those, it is more of the same. And I think the newfound optimism, or the updated optimism, is what people are calling out on what is called upfronted sales. both in terms of the type, the application and development type of opportunity or the digital transformation opportunity in IT. So, so if you talk to and see what Infosys and Wipro, TCS are talking about, or what Accenture is talking about in terms of their consulting side of the business, they are busy as hell on both sides of the business. And clearly the recent sort of upgrade on guidance and Accenture also points towards that this could be a nice sort of 18-24 month period where there is an improved visibility and a couple of notches of higher growth, and that's what the market likes, and we like it as well. So that should be sort of par for the course for some time to come.
Well, Ayaz, really appreciate your time. Glad you could join us, and have a wonderful year ahead.
Thank you.
Mr. Ayaz